You and I both know that over the holidays, you give and take a little bit too much. You overindulge, drinks, food, spending. And so we're going to focus on the spending piece here, especially since you do own a home and you have this mortgage and you've heard about a refinance in the future, but you just don't know what that necessarily looks like. And maybe you've refinanced a few times, but there's a reason why people do so, and everyone's reason is a little bit different. And so let's go over 5 reasons that oftentimes do come up. One, when rates are moving 0.5% lower, if not more, from where you're currently sitting, it can make a lot of sense, especially depending on how long you plan on staying in the home. That's the biggest question there. 2, reducing monthly payments. We all know the bills don't stop, and with inflation the way it's been, it's stretching our dollar. We got to stretch our dollar out, and so if we can reduce, some of that overhead, pay down some other debt, we do so if the numbers make sense. So that's a big thing. 3, consolidating debt. Debt happens. Especially when you have a family and kids and your car breaks down, going back to the Jiffy Lube every 3,000 miles. It's always something. New tires. That's probably one of the more fun bills out there. But stuff's going to happen. And so if there's a way for us to restructure it to pay off some more debt, why not? Switching loan programs. Some of you, you may have an FHA loan. And if you do, there's a mortgage insurance premium in there that doesn't go away. And so if you've been in the house long enough and your home's appreciated to a certain number, it could just be eliminated completely. And that could be $100, $200, $300 that you no longer have to pay. So that's great. And then 5, having the accessibility to your home equity, which is your money, and sometimes it's hard to be able to touch. So whether it be completely reconfiguring your first mortgage, that's an option through a cash out refinance, or it would be through a HELOC, a home equity line of credit. Both great ways, depending on what's most important to you, to have access to those funds. And so as we look at 2024 and beyond, let's really start to think about that 3,000 mile checkup for a car, like a 6-month mortgage checkup in the real estate space. And it's worth a conversation, whether it be 15 minutes, 30 minutes, 60 minutes. Let's get to talking, because when you think it, you talk about it, you analyze it, there could be opportunity, there may not, but you might as well see.